Well, I think, gold structurally serves as as an important asset, an important contra currency asset. And I emphasize that it's not just, we talk a lot about the US because we're based in the US and we think about the US, but the reality is that sort of circumstance exists across the developed world in the sense of basically all developed world economies in one form or another have, government debts that are too high relative to what's likely to be paid back, given their demographics. They have, they're in this, particularly in the West, in this transition from low cost producing to higher cost producing and higher inflation. These are all the sorts of things that, inevitably mean that money as we understand it today will be devalued relative to stuff, and the best instantiation of stuff that is from a financial asset perspective is gold. And so it's why the path will almost certainly not be linear, meaning like gold's
Correct.
just not going to directly go from 4,000 to 10,000 over the course of the next linearly over the course of the next 10 or 20 years. It does mean that that structural pressure will exist. And I think for most investors, like most investors are up to their eyeballs in bonds and hold no gold. And this, I mean, you'd think that they would have learned, given like the last few years have been like the worst bond market returns in history and some of the best gold returns in history. But still, basically no investors hold gold as a strategic part of their portfolio.